Wednesday, November 13th, 2024, Monaco 64, home of alternative economics and contrarian views. So yes, I'm back from Zurich. I got back last night. I had a good time with a couple of friends at the Precious Metals Mining Summit. Back to usual schedule now. Didn't post a video yesterday, but I think today could be a very important day. And why is that? Well, we've got the CPI data, and I see that CPI, which is a measure of prices that people use to gauge inflation. And the reason why I say that is because inflation really is the increase in the supply of money and credit out of thin air. Yeah, that's coming out today at 8:30 a.m. Eastern Time. It's expected to rise from 2.4% to 2.6%. So it looks like CPI is going to be going the wrong way. And the Fed, of course, has like an implied target of 2%. And that's not good. And I know the Fed looks at the PCE. I think a lot of the euphoria we're seeing after the election and the Trump win. And what do I mean by that? Well, the dollar rising very sharply versus other fiat currencies, versus gold, and also the stock market's going berserk to the upside. That could be in peril if the CPI comes out higher than expected. Just a quick recap of the conference in Zurich. Well, I listened to a couple of interesting speakers. One of them was Ronald Peter Stoffele. He's from Incrementum, who published a lot of research on gold. And he's always an interesting person to listen to. And what I thought was interesting about his presentation is that he thinks there's a new, it's a new paradigm now. He thinks the 60-40 stock and bond portfolio, that's history. And I agree with him. I've been talking about that to you as well. He thinks the new one is going to be 45% stocks, 15% bonds, 15% physical precious metals, 10% precious metals, mining stocks, 10% commodities. And there's one here that he has as 5%, which I don't necessarily agree with, and it's Bitcoin. But there you go. I thought that was significant. And Mark Faber as well was there. And he had like a fireside chat with Grant Williams. He said a lot of interesting things, Mark Faber. I like him a lot. But one of the things that was interesting is that he noted that back in 1929, Herbert Hoover was inaugurated in March 1929. And then just over 6 months later, the United States entered the Great Depression. We had the stock market crash. And what's that got to do, let's say, with Trump? Well, Herbert Hoover was a businessman. He was very successful in the mining sector. He made a fortune. And I wonder, I haven't looked at it in detail, but I wondered if Americans were thinking, oh, we've got a businessman in the White House, everything is great. And there was even one of the economists who said at the time that we had reached a plateau of prosperity and that we'd never go back down again. So I'm not trying to say the same thing is going to happen with Trump, but I thought the comparison was really interesting by Mark Faber. He kind of compared Hoover with Trump, and Trump is seen as someone who can fix things, who could fix the economy, who's been in the private sector. And I also met one of the Gnomes of Zurich there. And who are the Gnomes of Zurich? Well, it's kind of a pejorative term or disparaging term that the British government and the British Labour Party gave to the bankers in Zurich back in the 60s because the British pound had a tough time keeping its peg to the dollar and to gold. There's always talk of devaluation, and the Zurich bankers were, they were always testing these pegs. And I think it was, it says here on Wikipedia, although Swiss bankers had been criticized in Britain since the 1950s, the term Gnomes of Zurich originated in the crisis meeting of the Labour politicians in November 1964. The politicians blamed Swiss bankers for raising speculation against the pound. During the meeting, politician George Brown criticized the Swiss bankers and said, "The Gnomes of Zurich are at work again." So that stuck, and even the Americans started using that. And back in 1968, as you can see here from the LBMA, London and New York decided to close the gold market from March 15th to March 29th for a couple of weeks. And why do they do that? Well, because they couldn't keep the dollar pegged at 35. The price, the Bretton Woods system broke in 1968, basically. I met one of the Gnomes of Zurich. He wasn't around in the markets in the 60s, but we decided to use that term, and he liked it because he doesn't want his name out there. But I sat with him for a couple of hours. He watches the channel, so we met on Monday after one of the speakers. We met, and he showed me dozens of charts going back hundreds of years. And he does a lot of long-term research. And and I said, well, maybe I can use the term the Gnomes of Zurich. And he laughed. He said, oh yeah, that's good. And he said that term was used quite a lot in 1968. And why? Well, because during that period that the London market closed for gold, the market in Zurich kept trading, and the Americans and the British weren't happy with the Gnomes of Zurich. But what I really wanted to talk about, and we looked at gold, silver, the stock market, but we also looked at bonds, because the Gnome of Zurich that I met, and I met him yesterday as well for another hour, and he gave me some charts which are really interesting. I'll show you one of them, which is British pound versus the Swiss franc since 1860 to present. And here you go. That shows you how the British pound is done really badly versus the Swiss franc. And he said, still though, the best thing to have had is gold, not Swiss francs, because the Swiss franc is also being trashed versus gold. But you see this line up here, that's during when money was a fixed measure of value. So one sovereign was worth 25 francs. And the sovereign equivalent in Switzerland is the 20 franc Vreneli coin. It's worth a little less than, in terms of weight, than the sovereign. So it's not really 1 to 20, it's 1 to 25. And that's, again, what exchange rates are about. They are measures of values of gold coins and silver coins for that matter. But back to the bond market. He thinks, of course, the stock market is heavily overvalued. He sees a big correction, and we can talk about that in another video, but I'm going to focus here on the bond market. And he was a bond trader in the 80s. He ran a bond fund for one of the big Swiss banks. And he was telling me the mentality or the feeling right now is very similar to what it was in the early mid 80s. Back then, people were still afraid of inflation. They thought bonds were a bad investment because they had been up until 1981. And he thought otherwise. He thought bonds were going on a bull market. And he did very well because he was buying bonds, and generally the market was going higher. Bond prices and yields are going down. And yes, we topped at above 15% in the 10-year yield in 1981. But now he thinks the sentiment is complete opposite. There's a lot of people who still think bonds are the place to be, that if there's a crash in the stock market, people will rush to bonds, and that yields could go back down to zero. But he thinks it's just like in the 80s in reverse. And he thinks the CPI number today will be key. If we see that number slightly higher, it could trigger a lot of problems for the bond yields. He's looking for a big spike. And I kind of agree with him. The timing, though, is always difficult. But that's what we have to look at today. And just looking at the 10-year yield, and we cover here the bond market quite a bit. That was the market that I worked in when I was in the city of London for over 20 years. And I noticed yesterday when we were traveling, my friends and I, back in the afternoon, that bond yields were like up 10 basis points, which is quite big, the 10-year and the 30-year. And this morning we're at 445. 450 is always an important number, like in the bond market, the 4.25, 450, 475, 5%, always these round numbers. So keep an eye on the bond market, because very few people really follow the bond market. It's the most important market because it sets the price of credit. And the higher these yields go, the worse it's going to be for stock prices and for bond prices as well, of course, for mortgage rates, for the economy. So I think the whole Trump euphoria could be in danger here from this CPI number, and you could maybe be conspiratorial and say to yourself, who's in charge of the statistics right now? Well, it's still the Biden administration, and they could spoil the Trump euphoria by coming out with a really strong CPI, or they might not. Who knows? That's what the Gnome of Zurich thinks, and I kind of tended to agree with him. But even if we have a CPI that is in line, like at 2.6%, the market could turn, because central banks like the Fed, ECB, Bank of England, the Swiss National Bank, they're not bigger than the market. They can try to influence the market by intervening. But as my friend from Zurich, the Gnome of Zurich, said, they can't go against the underlying trend. And like me, he agrees that bond bull market is finished. It finished in 2020 when the 10-year yield bottomed at 0.3 back in March of 2020. And we might even have a number that is in line, but see yields spike really high. We'll have to see. Keep an eye on the bond yields. You can find them on investing.com. I'm going to put a link to it below in the description. And what about gold and silver? What's happened the last few days? Gold and silver have dropped sharply. Am I concerned? No, and we have to take things into perspective, I think. The fundamentals haven't changed. The fundamentals are still there for lower dollar, lower fiat currencies. And what's that? Well, it's the debt, it's the deficit spending, it's the big government, It's the geopolitical tensions. Interest cost for the Treasury is over $1 trillion, which is around 3.4% of GDP. And that's why this CPI number is really important, and bond yields are really important as well. Yeah, to take it into perspective, we earlier this year, I think it was February, gold traded as low as 1960, 1980. And right now, as I speak here, it's almost 8 o'clock London time. It's at 2,606. And I know it's dropped sharply from almost 2,800, the spot price. But nothing goes up and down in a straight line. And if anything, this is an opportunity to keep stacking for people who've missed the boat. Could we go lower? Oh, anything's possible. One thing that's encouraging is that silver is held at 30 level. Right now we're at 30.85. We've traded back above 31 earlier overnight. So yeah, that's how I see it. And the Gnome of Zurich has some really interesting targets for gold and silver, which we'll talk about in another video. I just wanted to cover what's really important today first. So what else is going on this morning in terms of the markets? Well, as I said, gold and silver are up slightly. Gold is holding now, 2,600. The Dow futures is down 154. The S&P is down 13 at 59.73. And the NASDAQ 100 future is down about 50 points. I think it was John Maynard Keynes, and he's not one of my favorite economists at all, probably my least favorite. But one thing he said that's very true is that markets can remain irrational longer than one can remain solvent. So you need to be careful. Don't use leverage. So anyway, with that, I'm going to wish you all a very good day. Take care. Bye.